Hi, my name is Kingsley. Thank you for watching this little video that I've created. In this video, I'm going to talk about a company called Singtel. I'm sure a lot of you, especially my Singaporean friends, have actually heard of it. And what is topmost on the minds of many investors is this: is Singtel actually undervalued? Alright, so in this video, I try to answer that question adequately for myself and for the viewers as well. So without further ado, let's dive right in. So we're going to talk about the three telcos here today: M1, Singtel and StarHub. But for the purposes of this video, we're going to arrow in on Singtel. But of course, you would have to do some comparisons along the way to get a sense of Singtel's competitive position. Alright, so here you are. Let's dive right in. So this is what we'll discuss here. We'll talk about the industry economics, which are really getting more competitive, as you'll see later on. We'll talk a bit about M1 and StarHub, the competitors of Singtel. And then, of course, Singtel has got 4 major business segments. We'll talk about that as well. And something interesting popped up as I was doing the analysis of the company as a segment called Group Digital Life. It could be a possible growth engine. And the last few things we're going to talk about is basically the dividend matters, which is what really matters to a lot of investors out there, the free cash flows. And I'm going to try to take a step at valuing the company. Alright, so let's move on to the next slide. So let me just repeat this by Warren Buffett. With few exceptions, when a manager with a reputation for brilliance tackles a business with a reputation for poor fundamental economics, it is the reputation of the business that stays intact. Warren Buffett. The industry economics of Singtel and all the telcos are becoming a lot more competitive, and all the telcos are actually being affected by it. With M1 was delisted in April 2019 of this year. It was acquired by Connectivity, a Keppel Corp-led joint venture with Singapore Press Holdings. And the question is, why delist, right? So perhaps, I'm just speculating here, but they could channel the dividend payments that they pay the shareholders towards restructuring the company and explore perhaps alternative growth paths. And if you look at StarHub's revenue and dividends, the revenues, with regards to the revenues, there's no real discernible trend, right, in the revenue per share for StarHub and also the total revenues. In 2014, you've got around 2.4 billion, right? In 2018, it was still around 2.4 billion. So there's no real discernible trend in terms of the revenue. But if you look at the dividends that have been paid out over the years, 2014 it was 20 cents per share, 2015 it was 20 cents per share, 2016 it was 20 cents per share, and then it went downhill from there. 2017 it was just 17 cents per share, in 2018 it was 16 cents per share. So this is the changing telco landscape as reported by Singtel. Basically a whole lot of technology disruption, rising competition, that's for sure, new mobile entrants and new mobile virtual network operators. Apart from that, they would have to continue increasing capital requirements and capital expenditures, and also a whole host of other regulatory challenges. And if you look at the rates that the other competitors are offering, the rates of these services actually falling quite drastically. I mean, you've got Circles.life offering 20 gigabyte for $18, M1 offering 30 gigabyte for $15 per month, alright, and TPG even $0 for the first 12 months. So the competition has actually heated up quite a bit. This is taken from an article from Today Online in September 2019. So as a result, what we have here is StarHub's share price actually falling from 2016 from above $4 per share to $1.40 per share. And of course, Singtel's share price has fallen as well, but not as bad as StarHub. So the 4 main business segments are Group Consumer Life, Group Enterprise, Group Digital Life, and Corporate. Alright, so if you want to do a deep dive on Singtel's businesses, by all means go look at these 4 segments. So let's start first with the Group Consumer segment. Alright, so we're talking about the numbers and or rather more acutely the segment EBITDA. For Group Consumer Life, this segment is producing relatively stable cash flows. Now you can see here in 2015 it was 3.3 billion, dropped slightly in 2016, still around 3.3 billion in 2017, above 3.3 billion in 2018, and about 3.2 billion in 2019. So apart from the drop in 2019, if you look at it from a 5 to 6 year perspective, the group's results are relatively stable. So that is generally a good sign. So it also means that basically the revenues of this particular segment won't disappear altogether the next year. So that is something that you might want to look at. And then we've got the Group Enterprise segment. Again, we're looking at segment EBITDA. We've got 2.1 billion, around 2 billion here, 1.9 billion, 1.9 billion, and 1.7 billion. Again, not a very nice picture to have, a declining trend, so to speak. And we've got the corporate segment, which is along this column right here. And you could see here in 2015 it was negative 71 million. In 2016 it was negative 76 million. In 2017 it was negative 88 million, negative 84 million, and negative 78 million in 2019 respectively. Alright, so these numbers are really not great if you ask me. So let's look at the last segment that we've got here, the Group Digital Life. Well, Group Digital Life, you've got negative 250 million in segment EBITDA, negative 136 million, negative 122 million, and then negative 92 million here in 2019. So what you see here are declining losses, which is generally a good sign. Singtel has invested quite a bit within this business segment, as you'll see in the next slide. So Group Digital Life, could it be a new growth engine for Singtel? Well, perhaps, right? If you look at Group Digital Life revenue, the revenues have been growing and also the losses have been falling. It's comprised of mainly a few entities right here, the most notable of which is MOB. And what I'd like you to take note of is MOB actually turned EBITDA positive in 2018, which is generally a good thing. So perhaps its investments in the Group Digital Life segment is coming to fruition. Alright, so these are the different little entities within Singtel Group Digital Life at a glance. So Group Digital Life revenues are actually growing. In 2015 it was 343 million. In 2016 it was 454 million. In 2018 it was 1.08 billion, and then 1.2 billion in 2019. So that's actually a good thing. However, 2019 results were not great for its associates. Airtel in particular here had to take a write down in its results. Airtel right here, which is one of its associates, had to take a one-time exceptional write down. So all in all, you see here the corporate basically pulling down the results of the group, and then you've got Group Enterprise, whose general trend is actually on a downward trend, where EBITDA is actually decreasing over time. Group Consumer Life remains stable. If anything were to happen to Group Consumer Life, you would see the valuation of Singtel actually dip. While Group Digital Life is still not earning positive profits, one thing to take note of is basically the increasing revenues in the segment and also its narrowing losses. So that's a good thing. So these are the dividends paid by Singtel, as you can see here. Right, this is 2019, 2018, 17, 16, 15, 14, and every year for the last 6 years it has paid an ordinary dividend per share of 17.5 cents. Now, of course, in 2018, Singtel actually listed NetLink Trust via an IPO. Alright, so that yielded some one-off exceptional gains, and hence the special dividends here. Now, the dividend coverage is not great. If you were to take the earnings per share and divide it by the dividends per share, you would get 1.08. So perhaps investors are becoming a little wary of the company's performance, and that is one of the reasons why its share price has dropped a little bit. But let's move to the next slide right here. So you look at the group free cash flows here. The group free cash flows here basically are pretty stable, if you ask me. Alright, so we've got 3.5 billion here, 2.7 billion, 3 billion, 3.6 billion, 3.6 billion, 3.6 billion. So the group free cash flows are pretty stable. And for 2018, its free cash flows is about 3.65 billion. Alright, so I believe that it's going to be able to slightly cover its dividend payout in 2019 and 2020. That shouldn't really be a problem if you ask me. Alright, perhaps another slide here that states here its free cash flows has been quite stable from 2015 to 2019 right here. So it wants to maintain a 17.5 cent dividend payout for 2019 and 2020 and perhaps beyond. So what I'll do next is I'll take a step at valuation. So 17.5 cents is the amount of ordinary dividends that is paid for the last 5 to 6 years. Let us attempt to value that as a perpetuity. If the discount rate is between 5 to 8%, we're talking about an intrinsic value of between $2.20 and $3.50 per share. Now, with the increased competition and deteriorating economics, the intrinsic value range could move 20% downwards to $1.76 to $2.80. Alright, so basically, if you ask me right now, at $3.35, Singtel would be fairly valued. Alright, in fact, I wouldn't place too much hope on it. Another vantage point perhaps, if you look at the cyclically adjusted price to earnings ratio based on the 6-year underlying net profit per share of 14.9, if you invert 14.9, you get an earnings yield of 6.7%. So you're an investor right now, you're getting an earnings yield of 6.7%, you're a business owner. The question is, would you be happy with a 6.7% return per year? So that is something you would have to answer for yourself. So for me, I don't think I would. Alright, so investing really is not just about arriving at an intrinsic value that you're comfortable with, but also at the same time, you would have to look at other candidates to invest in as well. Alright, it's really an opportunity cost. So if I invested in Singtel and my upside was say $4, and I had another candidate where I invested at say a $1 share price and then its potential upside is $4, looking at a risk-reward basis, I would take the alternative candidate. Alright, so this is just my view. And of course, there are cheaper competitors around if you look at it. You've got China Telecom trading at an enterprise value to EBIT of 6.9 times. You've got Maxis Berhad trading at an enterprise value to EBIT of 20.5. So that's cheaper than Singtel's. What Singtel has going for it right now is basically the dividend yield. But because its industry economics has been deteriorating, the company has been living up to 2.89 times debt to EBITDA compared to its other two competitors that I've selected here. It's a lot higher. So that's something to think about going into this deal or investing into Singtel. So if you'd like to know more, you could visit the website that you see on the screen right here, www.theholyfinancier.com. And with that, I end the video. I hope to see you again next time. Thank you.